Not too long ago, I had one of the biggest meetings of my life. My partner and I had several discussions with a high net worth individual who wanted to build a portfolio which essentially mimicked our personal investments. We already had several phone calls on the topic, and we scheduled an in-person meeting to go over the details and potentially come to an agreement. After about 3 hours of discussions and negotiations, we ended up creating a structure that worked for everyone, and the investor ended up cutting us a check for $1 million. It was definitely one of my favorite moments in my career. I thought it was pretty cool. Well, our guest for today most likely wouldn't have even taken that meeting because his business model is to only work with centimillionaires and billionaires. In fact, he has had similar meetings where the close of the deal meant that he now controlled an additional $500 million of equity. So if that doesn't clue you in, today it's all about family offices. We've talked about the topic before on the show, but we haven't really focused on it specifically. So today we're going to get a lot of questions answered. Number one, what categorical shifts, if any, need to be made if you're planning on working with centimillionaires and billionaires and raising capital from them? What are some of the investing strategies that family offices implement that our guest has learned from them that everyday investors, mom and pop, sophisticated, accredited investors can also implement? Also, what are some of the main key takeaways that our guest has learned working with some people that have been absolutely successful in the world of business? And also kind of a bonus question, but I think it's an interesting part of the conversation. Given the rhetoric that we're hearing in the news about, quote, millionaires and billionaires and how they need to pay their fair share, what does the future of the family office look like, especially in the United States? All these questions are going to be answered and more, so really a jam-packed episode. Hey, if you haven't yet, make sure to go to cashflowconnections.com and create an account. If you click invest in the top right corner, you can get access to our investor portal. We have a mobile home park and self-storage fund, which currently has 16 performing assets in it. The fund is managed by two of the leading sponsors in their respective asset classes. We actually have more than 200 investors are currently invested. 13 million has been raised. We'll likely keep the fund open until we've invested a total of 15 million. So really not too much time left with this particular offering. As you guys know, I am very bullish on the mobile home park and self-storage sector. I think with appropriate leverage, these asset classes make for a really great defensive play, especially late in the cycle. Of course, it's a passive investment. You get to rely on some real industry leaders, time, energy, expertise, and access to capital. Really all the things I love. We've already seen significant progress in the fund, and we continue to be impressed by the operating partners. Of course, past performance is not indicative of future performance, but we're really liking what we're seeing. And I've invested significantly in this fund because I'm a true believer in the underlying thesis as well as the operating partners. So if you haven't yet checked it out, make sure to go to cashflowconnections.com, click invest in the top right corner and create an account, and you'll have instant access to our offering. There's also a webinar on there that'll paint the picture very clearly. All right. Hope you enjoyed the episode. How's it going, everyone? Our guest for today is Richard Wilson, who helps family offices with a net worth of $100 million or more manage, create, and maintain their family office. Richard currently manages 14 clients, including mandates with 3 billionaire families. He is also the CEO of a $500 million single family office and the head of direct investments for another with $200 million in assets. Richard is also the author of a best-selling book in the family office industry, The Single Family Office, Creating, Operating, and Managing the Investments of a Single Family Office, and a recently released book called How to Start a Family Office. So we're definitely going to get into the topic of this family office investing, which is something a lot of people are fascinated by. Richard, thanks again for coming on.
Yeah, thanks for having me on the show.
So we're in a interesting time in real estate, but also we're in an interesting space because from my perspective, there is essentially 3 major investment groups out there. There's institutions, which most people are familiar with. There is accredited investors, but kind of in between those two and kind of a merge of both those two is this family office space. First of all, before we even jump into it, is that a fair categorization before we even talk about like what that even means?
Yeah, for sure. I think it is.
Okay, cool. So I want to talk a lot about this today, about how to raise money, how to manage expectations, how to manage the inner workings of families with a lot of money, et cetera. But before we do that, how did you get into this business? How did you start focusing on this niche?
Well, the short version is I grew up around my father. I raised over $1 billion for hospitals and universities. So I was kind of exposed to going to some of those meetings with him. And I heard a lot of stories from major donors and people who are writing into their wills, a $10 million or a $30 million gift, et cetera, to maybe a cancer wing of a hospital that helped their wife or their child or something. So growing up around that, and I was always starting businesses growing up. And then when I got out of my undergrad, I got lucky enough to get a 6-figure job doing publicly traded risk controls consulting work. And I did that, and it was deadly boring, but it paid for my MBA in cash. And I got bored, and at age 23, I said, who's going to pay me 6 figures to do something I actually want to do? And I figured out it has to be commercial real estate sales or raising capital for hedge funds, because it's just, you eat what you kill type mentality. And as I got a job offer in that space, I started to do some post-master studying at Harvard and moved to Boston. And so while doing that, I found that a lot of people at the institutional level won't invest in a hedge fund with less than 300 to 500 million in assets. So I had to go to down the totem pole to kind of smaller investors. And a lot of wealth management firms don't have enough accredited investors. So I had to go after what I just stumbled upon a term, which was family office. And that was in 2006-07. And I decided, well, I might as well not waste time with any other type of investor lead. So I started working only with them. And then for the last 12 years, what's happened is that many family offices speak to a dozen of their friends in the space, maybe 20 to 30 of their friends in their space per year, but they don't know what's going on macro. They don't know what's going on globally. They're not sure how to tackle direct investments, other areas that are quickly developing. And so very quickly, through writing on a website what I was learning every day and buying familyoffices.com and putting it there, it just kind of took on a life of its own. And I spoke a couple hundred times globally. We've hosted 100 of our own events now and published 13 books. And we just continue to document what we're learning along the way. And it continues to attract the ultra wealthy to us that are trying to figure out what to do now that they're liquid.
Yeah, well, that's really interesting. Especially, I like the component of the authority platform, because that's something that has really gotten popular, but it sounds like it's been useful not only for the accredited investors, which most people are familiar with via crowdfunding, but also in the family office space. So I'm actually really interested to get into the details of how you cater that content to that particular niche. So let's talk about, structurally speaking, what is a family office? I mean, break it down for us in terms of the difference between, let's say, accredited investors and what you do in terms of structure.
Sure. So a normal private investor or accredited investor will have their CPA. They might have a wealth manager playing defense for them and diversifying their assets. And they typically have their own business or a high earning position, perhaps partner at a law firm, doctor, et cetera. And usually that's it. And there's no central group organizing all of the affairs. With a family office, when you become wealthy enough, it could be at 30 to 50 million. It could be at 100 million plus. A little mistake that costs you 1% of your net worth due to paying extra taxes, or makes it so you pay 8% extra taxes this year, could have paid for a part-time or even a full-time person, just preventing that one mistake. And so as you get larger net worth, you need more holistic views and 360-degree management of your balance sheet, donations you're giving, watching out for liability and regulations. You might have 15 or 50. Some of my clients have 100 plus LLCs and 4 private jets, et cetera, and doing the accounting for that right and making a decision so that the funds come from the right trust account. It's timed right. It's done in a tax efficient manner. It's done in the best investment frame of mind and is in coordination with everything else going on in your portfolio. It takes a lot of coordination. So it's really a more holistic solution for those that are ultra wealthy.
Yeah, I think that's a fair comparison there with especially the gross dollars when it comes to a full-time employee that only their focus could be to not make sure that one mistake doesn't happen. It's, as the gross dollars increase, it becomes more and more advantageous. So I think let's say you're just a small real estate investor that every now and then you make a mistake. Let's say something as inconsequential as, oh, I forgot my credit card for my business at home. I'm just going to pay for this FedEx. It's only $28, whatever. Well, when you start multiplying those numbers out, the scalability becomes so large. So what if it's $250,000 a year? Then you could probably hire someone $100,000 just to make sure that you don't forget that card. I mean, obviously metaphorically speaking, but I think that it's that leakage that's taking place. The leakage becomes larger and larger and larger as smaller and medium-sized mistakes begin to happen.
That's exactly right. And actually, it's funny you mentioned that exact example, which you said, might not be the real example, but I'm not worth $100 million, but we host large events, and I had a $250,000 bill from a big event I hosted, and my team moving too quickly paid that via credit card instead of via wire transfer and didn't read the fine print, and just the fees we paid alone would have gotten me a full-time employee. And so you can just imagine the types of mistakes when you have 4 private jets and 6 homes and people taking care of your homes and property managers and et cetera, et cetera. It could be 10 times that size of a mistake. So it could pay for the whole team on one mistake sometimes.
Right. You have to have a department just focus on credit card points, because those credit card points rack up. So how do you work with family offices? What's the way that you interact with them?
Sure. I think it's probably important for those new to the space just to point out that there are single family offices. So if I sold the Family Office Club for $200 million, I might want a dedicated team just to serve me and not anyone else. And that's a single family office. And then a multifamily office is like a very holistic, full balance sheet, long-term planning, wealth management firm. And it might serve 10 clients or 50 or 100 plus. But it's a scaled solution for many families to use a single platform. That's a multifamily office. And it's important to frame that because the work we do is help mainly the single family offices establish their solution for themselves. It could involve leveraging the work of a private bank or US Trust or Goldman Sachs type, or could leverage the work of a multifamily office to help them play defense in the marketplace. But then we also help families play offense and figure out their direct investment programs in the marketplace, which means if they want to invest in commercial real estate, perhaps they shouldn't do self-storage in Singapore and the office park that they work in, and then some multifamily in Denver. Usually families benefit from some focus and some strategic thinking when it comes to their direct investment portion of their portfolio. And we help with either starting a family office or helping with that direct investment program part.
Okay, good. You actually touched on a lot of things that I want to get into deeper in the conversation, which is that kind of weighing the differences between diversification and focus and that direct investment versus the passive investment. So we'll definitely talk about that a lot. So what is, from a structural standpoint, and I know there's a lot of variety because there's family offices with $10 million and family offices with $5 billion. But from a structural standpoint, what does the structure typically look like? Are there different divisions that focus on different investment types, or what does that typically look like?
Yeah, it's a really good question. Most people start out, they get liquid and they have a wealth advisor. And then they do some investments that just kind of land in their lap, a friend that has access to them, somebody local has an exciting startup. And a lot of families just don't approach it like a simple 3-part game when it comes to their portfolio. And I think this single idea, if somebody gets one thing away from this and they're worth 10 million, 20 million plus, I think this might be the most important part of the interview, is approaching your portfolio and thinking of one bucket being your defensive portion, which is traditional wealth management, diversify to the extreme, get things that are uncorrelated, stocks, bonds, commodities, etc., and having that be section 1 of your portfolio. The second bucket or section could be cash flowing commercial real estate, not development, not anything too experimental or risky, things that are cash flowing day in, day out, and can be relied upon as a hard asset, hopefully some money refinanced out in the future, and can be held for the medium to long term, and as a real asset you can visit and point to and touch. The third section in structuring the family office would be the direct investments, which is typically in the industry where the family made their money. If the family made their money in self-storage, it could be in that space, but it could be software in self-storage. It could be the number one conference or thought leader or training workshops in self-storage, as well as actual self-storage investments. For many families, it's manufacturing, consumer products, whatever the space is where they made their money, or the space where they say, hey, we didn't make our money in cannabis or stem cells, but we think that is a wave of the future. So we're going to go into that and going forward, be focusing on that area. And that's where they play the most offense. And so it's varying degrees of control and varying degrees of aggressiveness, so that on the one hand, you have the ultimate defensive type mindset approach and distance from your money. Somebody else is managing and making almost all the decisions for you. You're just giving them input. In cash flowing commercial real estate, you might leverage a third party, but be giving input and deciding on the focus. And then on the direct investments, it's maximum focus, maximum offense, and maximum control, typically within a family office.
Okay, yeah. And glad that you broke it down like that. And I also like the way that cumulatively these represent basically all the goals that investors are trying to achieve. You have that predictability of outcome coming from the more defensive plays, coming from the cash flowing real estate. You have the more speculative investments that are either direct or kind of through a third party to a certain degree. But again, all of those buckets, those three that you just outlined, they're all working towards a similar goal, but individually they may not accomplish that goal, but cumulatively they will. So I really like the way that you broke it down there in terms of the portfolio.
Sure. Yeah. And I think that the most important thing that I just want to make sure that people get who are listening to it is that everybody has beaten the drum of diversification, for the last 30 years. And it's the holy grail of wealth management, right? But the thing is, people take the diversification approach and they take that to direct investments and they think they're being smarter by doing a startup in the food space and investing in a retail ice cream shop and then investing in self-storage and then their friend's cannabis startup and then, something else that seems to be on trend and they're diversifying, quote unquote. But really, families who are playing offense should probably stick to what they know best, where they have an edge in the marketplace, where they have some sort of superior positioning and insights. And if you look at 50 deals in stem cells, I would bet that the deals you do after that are going to be better and your total returns are quite likely going to be better, not always, than if you spread your money around and trust other people and trust the deal in front of you is actually a superior deal to be investing into. And I think that's something that people get kind of twisted in their brains. They think diversification everywhere when it can actually be diversification when it comes to direct investments.
Yeah, I agree. And that's something that I'm in the passive sector of the investment world. So I help accredited investors invest passively. And so it's interesting because I am actually extremely focused. My investments end up being diversified, but my focus is specifically on identifying great passive investments. So kind of to your point there, all I do is review passive investments. Now they're in different asset classes, et cetera. And I don't consider myself to be an expert in all of the asset classes I've invested in, but what I am an expert in is identifying great operators. And so it's a confusing space because we're trying to achieve that diversification, but at the same time, especially if you're being a direct investor, meaning the actual owner of the asset, making most of the decisions on the property, you have to have a level of expertise. That level of expertise comes with specialization, and specialization is basically the opposite of what most people think of when they think of diversification. And so you're kind of balancing those two things there. So again, I think that does make a lot of sense. So let's say, for example, that a friend of yours comes to you and says, look, I just exited massive company. We experienced a $500 million windfall to my family, and I really need to create, and obviously they've been preparing for this moment for quite some time, but now is the time in which we need to actually create this single family office. What are some of the questions that you would ask them to establish or guide them in terms of their directive, in terms of their investments?
Sure. I'll go over some of the top 5 to 7 questions, but we actually have 50 standard questions we start with. And these are questions that sometimes people aren't asked when they get a liquidity event. So we just give those away. We have a whole data room of resources for people that have a liquidity event that's free at centimillionaires.com. It's C, starting with a C, centimillionaires.com. And we think giving away this Word document with these 50 questions is just really important. It doesn't cost us anything to share it. But it's most important to make sure that you're thoroughly being asked all these questions, because otherwise every dollar you invest, every person you hire, you don't know if it's the right person for you because you haven't explored all the top issues. So some of the top questions are, what was your wealth creation story? What's the new reality you want to live in going forward? What's your mission, your objectives, your values? Who in the family needs to be planned for the next generation, for the current generation, for 2 generations down, and how involved are they now and what risks are there in place when structuring the family office on either family relationship risks, governance risks, or perhaps their involvement currently in a business is putting a business at risk, et cetera. Those are some of the top questions. And if you don't know what reality you want to live in as a family, then you don't know what to put in those 3 buckets. Or perhaps for a family that wants to work 1 hour a week and just get a report on how things are going, you might only be playing a defensive game. You might want to do only 2 of the 3 buckets in a very conservative fashion. So I think that those core questions are things that need to be really thoroughly discussed before taking any actions.
And this is actually one of the reasons I was so excited about this conversation, is because there's so much to take away from the family office space. A lot of this can be implemented by yourself. Those are great questions, regardless of whether or not you just experienced a liquidity event. You should always be ironing out the answers to those questions, because it's going to help you put your investment directive in place for your own personal portfolio. Now, it works at the highest level, but it also works at the individual investor level. So I appreciate you sharing that with us. Regarding the principals, how active do you see that most principals are in the day-to-day management of the family offices that they own?
I think that if they're first generation families and they created the wealth themselves, if they're under 70 years old, they're usually highly active. Sometimes after 70, they're transitioning or they're selling the portfolio. I know a couple of families that have had trouble selling their business for a price they think is fair. So they stay involved, but many times full-time CEO involvement past age 70 becomes rare. And each year after that, they're likely to pull back and be more of a chairman or just reviewing top decisions and hiring a CEO or putting the son in charge. So one of our latest clients is a $200 million family. We're just getting onboarded and starting their single family office for them. They just had a liquidity event 2 years ago, and they're grooming the son to take over. And the father's in his late 60s, and they're going to spend the next decade doing some acquisitions and starting to build the next platform company that they hope to ramp up to $100 million in their same industry they just exited. And I think that's a good example of what is fairly common age and transition wise.
What are some of the things that individual investors might be doing wrong that they're just not noticing because the gross dollars aren't that significant? That a family office would say, look, this is simply, we can't afford this mistake.
Right. Not looking at things through a tax optimization lens might be one, although some people won't feel like it moves the needle. I think another one might be that nobody became ultra wealthy through diversifying themselves to the extreme. Wealth managers are not there to get you from 1 million net worth to 20. They're there to make sure you don't go from 1 million down to 200,000. You might still dip 30%. At the worst part of a recession, or worse, perhaps. But their job is to make sure you don't do worse than the market and hopefully slightly better. And so you can't look at them as your balance sheet manager. If you don't have a family office and you're worth 5, 10, 20 million or less, it could just be worth 1 million. You are the one that has to be the steward of your ship and figure out what's going to be your value creation strategy, your platform approach. And a lot of family offices are not just smart and hardworking. They also had a good business model in a good area or a far superior business model in a very boring area. But they usually had some sort of momentum play behind them, which could have been the industry, rising tide, or just their dynamic approach to the marketplace. And a lot of them figure out ways to play a different game, to kind of monopolize intellectual property in a niche or really dominate a small niche or figure out a way to acquire clients very quickly and scale a profitable business quickly. And I think a lot of ultra wealthy play a more simple game, perhaps less multifold, and are diversified within very conservative assets. Like I know several people worth $5 or $10 million that their investments are a CD in the bank, their own house, one rental property. So there's no chance that those things are going to jump their net worth by $3 to $5 or $10 million. They're not allowing themselves to play a game that has that upside.
Yeah, I agree. And there's actually so much knowledge in that in terms of some of those perspectives on the business as a whole or business as a whole in terms of what's actually going to help you get those results that the centimillionaires have implemented. When it comes to actually investing in real estate, what does that structure look like? I mean, let's say the business itself is unrelated to real estate that created the net worth that the family offices are investing. Do you see family offices partner with sponsors or they themselves the sponsor, if that's not their background?
I see both, but many times they partner with the real estate firms. They like to be treated like they're something special, so they get a better valuation, they get better fees, whether it's a different share class or being a seed anchor investor or getting a different waterfall or performance-only fees, or as long as they invest a certain amount, get some sort of co-GP or co-investing rights. Along the way, those are all things they like to see. If all else was equal, they'd rather do the deal with somebody who treats them a little bit more as a JV partner and has strategic JV capital versus just feeling like they're dumb LP capital going into something, whether or not they are. And so I think that's important. Also, I think that depending on how much the family themselves want to be involved, a lot of them go to using independent sponsors, maybe fund managers, but they'd rather see the deals directly typically. They usually favor deals in the city where they used to live or currently live or are highly familiar with, so they can get to know the suburbs and the areas. Unless they're working with a firm so large that they're diversified across many well-known cities. Most of the time, all else equal, someone would much rather invest in their own backyard rather than a city that supposedly has good demographics. And they like to visit the assets if possible, make sure they can see them, see that it's real, understand the story, etc. And then also, I've just learned over time that families can move up the learning curve, even if they don't want to manage the properties themselves. If they would say, okay, we don't know data centers or self-storage or multifamily or office parks or RV parks, but where do we think there's an efficiency? Where do we think there's a local investment play to be had, et cetera? And perhaps just focus on one or two, because after you look at the pitch decks and meet with 30 different independent sponsors just in the data center space or just in mobile home parks, you're going to start to see familiar metrics. You'll start to see things that are much more credible than everyone else, or much more interesting of a dynamic, or much better debt equity structure, or much better fee structure. And if you're looking at apples and oranges and bananas and watermelons, it's a little bit harder because something might look real exciting, but that's because it's a mobile home park in Alabama. It's not a multifamily in San Francisco, right? So it's easier if you're just looking at watermelons to find the one that's going to be the juiciest with the best colors, et cetera.
Right. You wouldn't have a frame of reference to understand what was actually a good deal.
Right.
You mentioned a couple different asset classes, particularly self-storage came up in a couple of your examples. Could have been just random, but I'm interested, what are the sectors that your clients happen to be investing in right now in terms of real estate?
Sure. I think that self-storage, multifamily, and office parks are three that everyone can get their arms around pretty easily. They don't need to be taught how it works, like blockchain or even cannabis or data centers. Most people are not intimately familiar with how a data center might work, and they've never been a client of one. Most people have lived in an apartment building or used self-storage or can figure it out. So I think that impacts where they're allocating. And mobile home parks have been coming up more the past 3 to 5 years, for sure. I've had a past client that created their wealth in that area. But I think it all comes back to the three trust curves people have to be aware of when raising capital or when looking to allocate. You have the trust curve. You have to move up on the leadership team and the founder and really believe in them and have high conviction in them. And then a trust curve of the whole industry and the ecosystem. And then the trust curve on the individual opportunity. So if it is self-storage, self-storage can be an example. You might have invested in the industry before, but you're based in Los Angeles. You know the team really well. You've known them for 3 to 4 years, but the deal is in Denver. So you have to get to know that deal and that local market. You're already up the other two learning curves. So the person who's working with you just needs to focus on moving you up that third curve on the Denver submarket that it's in, and not the other two. And this is why people raise capital from friends and family first and go to investors they've known for a long time first, because they're all the way up the trust curve on the leadership. So anytime you can go to an investor, if you're on the capital raising side, that's already up one or two of these curves, then things are going to go much better. And anytime you can just think to yourself as you're going into a meeting as an investor, what do we already know? And let's just focus all the energy of the meeting and just tell the person beforehand, we want to focus 80% of the energy of the meeting on this one area. It's just going to be a better use of everybody's time.
Right. What changes have there been in the sector over the last 10 years, the family office sector?
Sure. A lot of changes. I think that a new term is starting to be used called a virtual family office, which just means a single family office that's put together for somebody who's just worth 10, 20, 30 million, maybe 50 million. In the past, you've always been told if you don't have 100 million plus, then you can't have your own single family office. Well, a lot of people want the benefits of one, even if they don't have all the expensive infrastructure that a $200 million plus family might have. And so this trend of people starting a virtual family office is definitely growing. And we talk about that, and we have some free resources on that on singlefamilyoffices.com. So I don't think we have too much time to go into that in great depth. But the other part that's growing is the direct investment programs within family offices. Now it's a major reason to start your own family office is to do more direct investments, get better direct investment deal flow. And along with that, because of that, has been the emergence and growth of independent sponsors, which used to be called fundless sponsors. And this is so that someone doesn't have to go to a real estate fund if they don't want to and allocate, say, $1 million. And that real estate fund says, hey, we only invest in office parks in New York City. They're only 5% cap rate or better, and they're only in Brooklyn, Queens, and then sometimes in New Jersey opportunistically. And the fund says that, but then they raise the money, they go out, try to find the deals, And maybe some of the deals don't pencil out to be amazing deals, but hopefully they meet the criteria they've promised you. The new trend is to find that same group, which says, hey, we have that same strategy. We do 4 deals a year, sometimes just 2 if we can't find 4. And you're going to be able to look at them deal by deal. And if you want to allocate to all 4 for $250,000 each, you could. If you find just one that you love, you could put your $1 million in that alone. And that way you get full transparency on, here's the deal. We close in 30 to 60 days. Are you in or out? Since we've already met before, you know us. Now let's focus on you getting to know this deal. And that model has really kind of exploded this last 7 years into something that's pretty mainstream.
Got it. And has the crowdfunding space had an impact in the family office world, or is that something that basically only impacted accredited investors? I'm talking particularly about the 506C changes and, the online crowdfunding for real estate.
I don't think it's affected it much. Honestly, most of the groups that raise several million at a time already from family offices or $1 million plus minimums, et cetera, they view that as kind of very retail. They think it's going to be $1,000 to $10,000 at a time, waste of their time. Mm-hmm. But I think it's a wave of the future. I think that more and more people are starting to find and will find that it's a big advantage to use 506C, be able to have less scrutiny on what you say and what live conference type environment, be able to advertise more publicly. And over time, there'll be more sophisticated investor lead generation funnels being built by major investment management houses and managers out there. So I do think it's changing the space. It's just taken a long time for some of the more established groups to use it because they're doing well without it. But I really think that there's some smart players out there starting to put it to use. And in another 5 to 7 years, it'll be very commonplace, and there'll be people raising, $250 million a year using that.
Yeah, it's remarkable. Actually, we're working with a group right now. It's in the process of raising $100 million, and we're really confident that they're going to be able to do it.
Awesome.
We've raised upwards of 90, and I witness it. It's happening right now. Okay, so let's talk about something that I'm sure a lot of listeners are really dying to get into. I'll put it this way. The number of clients that I work with is quite significant. Having said that, having just a few of your clients can be completely life-changing for a lot of people listening to this show. Just being able to attract one high net worth individual or family, the implications are massive. So what does that take? I mean, walk us through how you sourced, without going into the details of the names, for example, but I'm very curious in terms of, what is it like to be in one of those meetings where you're pitching someone on potentially converting $200 million or $500 million over to your control to a particular degree?
Sure. A lot of it is adding value first and just not having a scarcity mindset and just adding value for the long term and always acting in what somebody would do if they were playing the long-term game. If you do anything that's really short-term or high pressure or trying to rush things along or just trying to sell somebody and that's their first interaction with you is you saying, hey, do you need this or do you want to buy this? They just don't respond to that at all. So I just try to be where they are looking for information. And I try to be an Excedrin for a migraine they have or an arthritis medicine for a type of issue that is commonly a challenge for families. And I think adding value first and being found by them when they're looking for a solution is one of the only ways to really grow a business in this space because, in my experience, they're not going to reply to the cold email or the phone call, even if it's very well crafted, like an angel investor might, because you're just getting such a volume of those all the time. And so many people want their business and want to come after them. They're going through the world with forward momentum and reaching out to things they need and grabbing it and bringing it towards them. They're not sitting back typically and just waiting for a bunch of pitches to come in. They rarely respond to those. So you really have to attract the families instead of chase them. And we have learned this over time. So we've created a few resources that have brought us several clients. We have, for example, our newest book, which we sell for $3. And again, we give it away on centimillionaires.com. It's called Centimillionaire Migraines. And a centimillionaire is somebody worth over $100 million net worth. And we provide in that book remedies to 6 of the most common headaches that almost all of my 100 million plus net worth clients have. If they don't have these headaches already, they're very likely to have them soon. So they might as well mitigate those headaches and those risks with processes and models. And we have videos and tools to use. And we just give all those away in the book. While my competition charges $500 an hour for consulting or $1,000 for a webinar, we just give more away and we're more generous on that in our public talks on YouTube with the Family Office podcast, et cetera. So if anyone is looking to build relationships in this space, I would see where family offices in your local area congregate. What are they members of? Where do they go? How could you help them? And look at your own background and DNA and figure out where that intersection is of how you could be highly helpful to individuals in a way that only people that are ultra wealthy would have that type of a headache that you're trying to solve.
Interesting. Okay. So you've put yourself in a position to solve their problems. You've done some work to be an authority and a thought leader in the space. And then let's say that they're interested, they're reaching out and they want to discuss, how you work with family offices. What does that conversation look like? We went through some of those original questions, but walk us through not only the lead nurture process, but also let's say the closing situation.
Sure. So at the beginning, they're usually reaching out and saying, hey, we're doing some homework on how to set up our family office, or we had a liquidity event and I'm helping my father just navigate all the options in the marketplace because I'm going to be helping him put together this solution. Typically, there's a short phone call, 15 to 30 minutes at most. We just talk about the situation. I listen a lot, ask questions, give them a couple examples of clients just like them that I work with. And then after the phone call, I follow up and provide them with our Word document of our 50 kickoff questions, maybe some resources like our family office assessment quiz, and just other things that are free, maybe attach a book or two I've written, etc. I'll send them a couple books, hard copy. And then the goal is to meet face to face. And I found that video FaceTime calls, if possible, are worth 5 times more than a phone call, and an in-person meeting is worth a lot more than a video call. So that's really important as a next step. And it's just a really matter of listening to them as you de-risk the decision for them and just figure out how you can win them over by being as genuinely helpful as possible and listening really carefully to what they care about. It could be that there's a ton of low-hanging fruit on their trust and estate planning, and that the savings there alone would pay for their family office for 5 years to come. Mm-hmm. But what's most interesting to them might be this new direct investment opportunity in this contract they're negotiating with a publicly traded company that they think is going to triple their net worth. So they're not annoyed that you want to talk about the trust and estate planning, but they want to make sure you're the right partner who understands their priorities and is going to not save them $5 million, but then they don't get the $100 million upside or something of that nature. So I think those are some really important components of it that I've learned, the hard way. Honestly, I've gotten some amazing leads, and then if I didn't follow up fast enough, or followed up too fast, or didn't listen enough, or didn't have the complete full balance sheet solution available for them, then, honestly, I've squandered some of those leads over time, obviously, just like anyone building a business. So I try to always be reflecting back on what happened when the leads do come in, whether they close or not, obviously.
Man, I really like that. I mean, number one, it's amazing how many books have been written about sales that tell the exact opposite of what you just outlined. Now, listening is something that the right people that are teaching sales, yes, they're going to suggest that you listen because that's how you're going to hear. But most of the things that sales books are talking about, it's about hearing the objection so that you can overcome it. And in nothing that you just outlined was it about overcoming objections. It's really about you're putting yourself in a position so that those objections are really questions about interest. And that interest is garnered by the trust in you that you've created through your authority platform or your thought leadership platform. But most of all, I have certainly found that the higher you go in the net worth category, the less and less pressure is going to result in a good result. Mm-hmm. I mean, high pressure closes with someone who has $100 million. They've been used to this their whole lives as far as they can remember. And it's just not going to be beneficial, but much more. We're talking about illiquid investments. We're talking about investing in real estate. We're talking about building a relationship that truly will last a lifetime or a multi-generational type of situation. That's not going to be a result of, false scarcity, for example. It's a result of really creating that relationship and showing that you want to do it for the long term. And if it's not that, it's not going to work, especially in this family office sector.
Right. For sure. No, I couldn't agree more. I think everything has to be done for the very long term. You have to be high integrity and have everything well integrated and aligned so that nothing seems out of place or in conflict with what you're saying to the family or doing for the family. I mean, at the same time, you shouldn't be serving them unless you are superior at one thing. So you also have to have complete confidence that in the area where you are serving them, that you can deliver a ton of value and that you are the right group to work with.
Let me ask you this. This is an interesting question that I should be asking everyone, but particularly someone in your position. There has been some really interesting changes just over the last 5 years in terms of the societal issues in the United States. In this next election, it's very likely that one of the leading candidates, if not all of them, are going to have no problem using the term socialism as part of their platform. What are your thoughts on that, and how does this relate to the sector that you're in, and what changes are they potentially making to address this concern?
Yeah, it's interesting. I mean, it's not a surprise why so many people are moving to Texas and Florida, from places like New York, Chicago, et cetera. I think that I don't work with lottery winners. I don't really work with too many professional athletes, although I do know several. I'm really working with the winners in the game of capitalism. And I think it's fascinating to look at what they've done to win the game and like the hard work they've applied and the models that they've done. And I don't think the winners of the game should be penalized, or it takes away the motivation to play the game. And I think that capital and intelligence is always going to follow where it can get the best relative ROI without severe pain of changes. People aren't going to move from San Diego to Singapore in masses, but people will move from Hong Kong to Singapore or New York to Miami. And they could move more so to places like Puerto Rico or Cayman Islands if the U.S. messes up its current status of sucking in wealth from all over the world. But luckily, for us, Chinese, Indians, even Russians, at the billionaire and centimillionaire level, almost all choose to send their children to, not almost all, but they usually choose the United States in masses more commonly than other countries. We're usually number one. Sometimes Canada is right up there for some countries that have a hard time getting into the United States. But a lot of the billionaires and centimillionaires want to come and live in the United States or have a residence here. And they do so because of the safety, lack of corruption, and because of the tax and business environment. So I think that needs to be respected, and we should be grateful for the global position we have business-wise to constantly attract so many ultra-wealthy into the US. And I don't really like to talk about politics a ton, but I do think that we should always be trying to develop a more and more robust platform to bring in the ultra-wealthy and have them investing in our infrastructure, our real estate, our businesses, and just have a superior capital marketplace that everyone else, head and shoulders above, is a really sustainable competitive advantage I think we could have.
Man, I really like that answer. I'll tell you why. Especially with the clients that you deal with, I could so easily see it being the case that people are just always crying about, and just metaphorically, of course, right, crying about the situation. Because look, I live in California, and I find myself, especially in my past, talking about the government, talking about all this, and everything's so bad. And the reality is, I absolutely love my life, and I love where I live. And this year, my fiance and I committed to staying here and raising a family in California. And that's when I decided to say, let's stop talking and just realize that I'm incredibly grateful for where I live. I love living in the United States. It's my favorite country in the world. If it wasn't, I wouldn't be here. And what you just outlined is so absolutely true. And the reasons you outlined it, that's what's really fascinating to me, because when you take a global look at some of the other options out there in terms of some of these situations. Yes, there are some other countries that have better laws in certain areas, but when it comes to protection of capital, when it comes to investment opportunity, particularly in real estate, the fact that we have cash flowing real estate all over the country is remarkable and unique, and the tax implications. Anyway, so thank you for that, because it does help put things in perspective. The richest people in the world, many of them want to send their children here to learn from this culture and this society and grow up in the laws that we provide. So that's actually a great takeaway from this, if nothing else. Let's talk about kind of the main differences working with family offices versus accredited investors. You said that you jumped right into that sector. So do you have a background working with accredited investors, or was the first capital you raised money from really the family offices?
I had helped a technology company go out and try to raise capital from angel investors when I was back in college. And then my first role really outside was raising capital for hedge funds when I moved to Boston. So I had experience calling on institutional investment consultants, and I saw their checklist mentality and what they needed. And I had called on wealth management firms and saw how hard it was to make progress.
Yep.
And the only way we started making progress really was providing education to wealth management firms and networks of wealth management firms that were connected to broker dealers and in family offices is where we started making all the natural progress. And I was trying a bunch of different strategies and, calling 60 people a day and following up via email and putting stuff in the mail. And I just found what worked was being helpful to them first. And then I could gain access and distribution and have them calling me instead of me calling them.
Yep. You're not going around hunting. You're just looking for a way to attract leads. It's something that definitely helped me in my career as well. Okay. So before we jump off, one last question, not necessarily in terms of the investment strategy, but what are some of the reoccurring things you've seen working with family offices in terms of how they actually generated and created their wealth?
Sure. I think one thing is viewing their portfolio, at least the direct investment part, almost like a chessboard. And they have different parts of the portfolio that do different things for them. I think they like to find parts of their business that give them a superior information edge or build their reputation, even if that part of their business only makes them a little bit of profit. Maybe it also gets them deal flow. It also gets them capital partners. It also gets them new business ideas. And so it does a part that maybe if their competitors don't have that, their competitors have less exposure, or maybe they have higher costs, et cetera. For example, if you're in commercial real estate and you are investing, but you also have a leasing business in that same region, you might be very on top of who's renewing a lease in top buildings, what are the trends when the market's getting soft or not, and you might have more knowledge of the marketplace than others and be able to produce superior returns or get superior deal flow because of that multifold business approach. The other thing I've seen is just a idea I first saw in Vern Harnish's book called Mastering the Rockefeller Habits, but I've noticed it in many family offices portfolios. And that's the idea of having control of choke points in your industry. So you might have a lot of intellectual property. You might have the best real estate physically in a city. You might have the best positioning in a certain industry or access to something superior or something that might be painful to your competitors. You might have superior excess supply of it, and you're able to make more progress every day because of that. And I've just found that many families try to secure such assets and advantages in the marketplace, and that they can be sustainable advantages when you can control choke points.
Yeah, playing the big boy game, getting that monopoly in whatever piece of the sector and just focusing on that monopoly is a great way to generate massive 10x, 100x results. So that's awesome. So before I jump off, I want to give you the opportunity to let the listeners know how they can find out more about you, your firm, and some of the books you've written.
Sure. So if you are a ultra wealthy individual and you want to access that data room and our latest book for ultra wealthy families, the best place to go is centimillionaires.com. And my Centimillionaire Migraines book is there. You can buy it on Amazon for $3, but we give it away for free on the website at centimillionaires.com. If you're raising capital, it's capitalraising.com. We've got a resource there for you. And then we do 25 live events per year, including investor summits and workshops. And if you want to check out where our next events are coming up this month and next, you can see that on our core Family Office Club website, which is familyoffices.com.
Awesome. Well, Richard, thanks again for coming on. I really appreciate it.
Yeah, thanks for having me on the show.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.